Welcome back. Here is one of the most common questions people ask about fixed-indexed annuities. If my annuity is linked to the S&P 500, isn't that basically the same as investing in the S&P 500? No, they are very different. One is an insurance contract designed to provide protection and possible income. The other is an investment designed to participate in the stock market. They may refer to the same index, but they do not produce the same results. Let's look at why. First, you cannot invest directly in the S&P 500 index. To invest in the companies represented by the index, you normally purchase an index mutual fund or exchange-traded fund. That fund owns or closely tracks the stocks in the index. A fixed-indexed annuity works differently. Your money is not invested directly in the S&P 500. Instead, the insurance company uses changes in the index to calculate how much interest, if any, to credit to your contract. You do not own the stocks. You are receiving interest under the rules of an insurance contract. One major difference is what happens when the market falls. A traditional fixed-indexed annuity commonly has a 0% floor for index-linked interest. That means if the index falls, the contract may credit 0% instead of a negative return. You do not lose account value simply because the index declined. However, the annuity is not completely risk-free. Withdrawals, surrender charges, and rider fees may reduce your value. The guarantees also depend on the financial strength of the insurance company. An S&P 500 index fund does not provide that downside protection. If the market falls, the value of your fund can fall with it. You receive the market's gains, but you must also accept its losses. In exchange for downside protection, the annuity limits some of your upside. It may use a cap, a participation rate, or a spread. A cap places a maximum on the interest you can earn. A participation rate gives you only a portion of the increase. A spread subtracts a percentage before interest is credited. The insurance company may also be allowed to change these terms for future crediting periods within the limits of the contract. An index fund does not use these limits. Dividends are another important difference. An S&P 500 index fund generally receives those dividends and passes them to its investors. A fixed-indexed annuity usually calculates index growth without including dividends. The annuity is generally linked to price movement, not its full total return. Suppose the S&P 500 price rises by 12%. The annuity reaches its 7% cap, so it receives 7%. The index fund participates in the full increase. Now suppose the index falls by 10%. The annuity credits 0% under our example. The index fund loses value with the market. Finally, suppose the index rises by 5%. Because 5% is below the annuity's 7% cap, the annuity may receive the full 5%. But over time, strong market years can create a much larger difference because the annuity's upside is limited. The tax treatment is also different. Growth inside a non-qualified annuity is generally tax-deferred. An index fund held in a taxable account may create taxable dividends and capital gains. The index fund is also generally easier to sell. An annuity may have surrender charges and limits on how much you can withdraw during the early years. Here is the main takeaway. A fixed-indexed annuity is not a safer way to receive the full return of the stock market. It is an insurance product. The question is not, which product is always better? The better question is, what job does this money need to perform? You did excellent work today. Remember, the same index does not mean the same investment. In our final lesson, we will bring everything together into a practical checklist. I'll see you in Lesson 10.